Price stability is low and stable inflation. But in recent times, what you probably noticed all throughout the world is that the inflation numbers were well anchored. Well anchored in the sense most of the countries not only maintain low and stable inflation numbers, but at the same time they have managed the inflation expectation. So they have anchored inflation expectation to great extent, and in this process, the central banks were considered that they are fulfilling their main objective in majority of the countries, but at the same time, there were consideration in terms of central banks' role in terms of the usage of productive resources in economies. To say that the central banks are also required to assist in the process of full employment. That means to get productive resources employed in the economy. So in that process, as we started discussing last week, central bank uses many tools in terms of driving their objectives to be achieved. But we call these tools either in the form of conventional monetary policy tools or non-conventional. Right? So to start with, we have touched upon the conventional monetary policy tools. And throughout the world, they are no different. They are mainly three categories. One is OMO, okay? And you know, through OMO, any effort engaged by the central bank would result in the amount of reserves and the monetary base, either to increase, either to decrease. That depends on which side of the open market operation the central bank conducts. Right? So there's influence to the quantity of reserves or the monetary base, and through which the other economic variables, particularly the interest rates. Right? So then you see changes in discount lending. Discount lending is also another element where instead of open market operations, you have the lending arrangements the central banks have established. So they have kept it ready. Banks could access. Right? So that also contributes to impact the monetary base. And also the so-called reserve requirement. This is a conservative and very conservative to say, because you don't change reserve requirements every day. You usually do a reserve requirement adjustment and then leave it intact for quite some time. You can't be changing reserve requirements all the time. Right? So in Sri Lanka right now, you see the reserve requirement is 2%, but at the same time, central bank has adjusted the discount lending significantly since second half of 2018. Right? So there's efforts in central banks to kind of, bringing adjustments to its discount lending operations, and also central banks engage in open market operation almost daily. Right? So you see this type of elements, this ultimately results in driving the economy to achieve its monetary policy objectives. And this section would cover these things. And we touched upon this from a very broader perspective in our last discussion. We opened discussing this in a detailed way last time. So we can continue. Okay. So you see this, the reserves, okay, and the federal fund rate. I'm talking about US, so you see the federal fund rate here. But if you talk about Central Bank of Sri Lanka and the Sri Lankan context, you would replace federal fund rate with call money rate. Okay, so market for reserves means the banks either at any given moment of time do not have reserves, required reserves maintained with the central bank, and required to raise reserves to meet their requirement, or they require lending because they have excess reserves in their portfolio. Therefore, there's a market for these resource funds, right? So the resource funds also do not come into play unless you see a kind of a periodic cycle central bank establish. Central banks usually keep a periodic cycles once in 2 weeks, like to balance reserve balancing timeline, reserve balancing day for that matter, right? So during that period, it fluctuates. The market who transact in these reserves and they decide a rate that is often the kind of a shortest market interest rates defined in any economy. Overnight money market interest rate. In Sri Lanka, most frequently used arrangement is the call money, and in US it's Fed fund rate, okay, federal fund rate. So there's a demand and supply for this reserves market too, okay. So through this demand and supply forces, we look at what happens to the quantity of reserves demanded by banks. And we again keep a kind of eye on, okay, this is economics, you keep everything else constant. Ceteris paribus condition, okay? And also what happens when the federal fund rate changes, what happens to this demand and supply forces in the market. But you already know, of course, we discussed about compilation of the models through which at times we have kept there is no reserves for our easy understanding, but you recognize there is always excess reserves also maintained by banks. In one equation, we just kept excess reserves 0 and total reserves are nothing but the required reserves. But in reality, total reserves are required reserves plus excess reserves. Okay, but this excess reserve is always an insurance against possible deposit outflows. When somebody comes to withdraw their money, right? So you either have your liquid assets in your portfolio, you can settle it off. If not, if you have excess reserves, you can withdraw from your balances in the central bank. Okay, but interestingly, keeping more and more excess reserves means the money is not working for you. You are losing your opportunity to make returns from the reserves that you are maintaining. Anyway, required reserves often do not pay a remuneration. Excess reserves is over and above required reserves you are keeping, that by that amount you are losing the ability to lend and make investments and earn profits. Okay, so the excess reserves is good, but keeping excessive excesses would have a real impact on your profitability. So that's very interesting assessment that you see in financial market. So, but interestingly, what you are seeing is the cost of holding reserves is the interest rate that could have been earned, as I said, by lending or investing, minus the interest rate that is paid on them, because reserves have nothing but from the deposit. So for deposits, you had to pay an interest. Okay, so by lending these deposits, you can make money also. So the difference between lending rate and the deposit rate is nothing but the cost of holding reserves, because you are basically not earning anything for this reserves amount that you are keeping with the central bank. So that's why the central banks all around the world keeping a very low reserve requirement. Yes, and over and above this reserve requirement, you keep excess reserves, means that you are kind of, you know, not necessarily managing your portfolio. But there is a possibility that still you could manage your portfolio with little excess reserves. So this is reasonably common in all throughout in terms of central banking operations. Right. So the demand in the market for reserves, and we will also see the supply in the market for reserves, and you will see the demand and supply curves interacting in the market. So we will come to that one by one. So the demand is, you know already, when it comes to a demand side, The demanders are the institutions who run short of required funds. But interestingly, when I say non-remunerated reserves, right, at different stages of business cycle, the central banks also decide to pay an interest to the reserves. And you probably see during the financial crisis of 2008 period, the Fed Reserve, US Central Bank, paid a very nominal, smaller return for reserves maintained by the banks. But this reserve rate, whatever the interest rate central bank has paid, is below the so-called Fed fund rate. Okay, so the market supply and demand forces define the Fed fund rate, but the central bank compensated the banks for reserves that they have kept with them during the period of the financial crisis. And this is not the normal circumstance. That's why they have paid. So they have paid a smaller compensation for those reserves. Okay. And also to say that in the demand side, when the Fed fund rate is above the rate paid on excess reserves, when you pay a compensation to excess reserves, then you see that payment is slightly above zero. If zero is the bottom or the floor, then what the amount that they have paid is slightly above the zero level. It's a very nominal compensation, but the Fed rate is usually above that. So when you see Fed rate is above the rate paid on excess reserves, right? But what you see is, as long as the Fed interest rate is substantively away from this excess reserve interest paid by the central bank, okay, the cost of holding excess reserves, opportunity cost of holding excess reserves is high. But if the gap between the compensation interest rate for excess reserves and the Fed fund rate, or the overnight money market interest rates, getting closer and closer, the opportunity cost of holding excess reserves also declines. Right? Then the banks become risk averse and naturally tend to hold more and more excess reserves. So this happened during financial crisis. You have seen the banks were keeping quite a big volume of excess reserves, right? Because there is no substantive difference between the Fed fund rate and the interest rates paid by the central bank for holding excess reserves, right? So during that period, the opportunity cost of holding excess reserves have almost become quite insignificant in US and in other financial markets where the market rates were very much equal to each other. Okay, but generally, what you are simply seeing is a downward sloping demand curve for demand in the market for reserves, because higher the interest rates, you probably find less volume being demanded. Higher the interest rates, less volume being demanded, and the lower the interest rates, you probably see a higher volume being demanded by the market. But then with the interest paid by the central bank, you probably find at a particular point the curve become flat at that trajectory, and that's become infinitely elastic kind of a curve. You will see that in the slide that we'll be discussing in a little while. So the supply side, you know, it's the market. Reserve supplier is the central bank. Okay, so when it comes to supply, you see reserves have so-called non-borrowed and borrowed component. Either reserves are non-borrowed or borrowed from the Fed Reserve or the central bank. Okay, but when you are borrowing from the central bank or the Fed Reserve, the cost of borrowing reserves is the discount rate. You are borrowing at the discount rate. In the case of Sri Lanka, if you are borrowing from the open market operations discount window, overnight lending rate. In Sri Lanka, it's not the single rate, it is overnight lending rate for borrowing. And also you see overnight deposit rate for excess liquidity banks have, and they can keep that excess liquidity with the central bank. So you see, in Sri Lanka, it is 2 rates for the overnight market, but in the case of US, it's mostly the single Fed fund rate. And when you wanted to borrow in the US central bank, you have to pay the discount rate to the Fed Reserve and finance. So at that discount rate, you can borrow any amount. Only thing is, you need to have collateral to pledge to the Fed Reserve in the US case. And even in the case of Sri Lanka, if you are borrowing from the central bank, you have to keep the collateral, often the government securities, that you have to pledge that government security to the central bank, and then you can borrow. Okay, so borrowing from the Fed is a substitute for borrowing from other banks. So often, when you see the discount rate, the market tries to operate below the discount rate and try to find their finances. But in the event that you don't have access to other banks due to limit restrictions, banks do not unlimitedly lend to their counterparts, that means other banks, because there's a risk limits, right? But if you want to borrow beyond a particular level from other banks, you can go to the central bank and borrow, but you need to have collateral. So you can borrow, but you have to borrow at discount rate. Okay, so anything that you borrow from the Fed Reserve or the central bank for this matter is a substitute for borrowing from other banks. So you also see that if the Fed fund rate is lower than the central bank's discount window rate, then banks will not borrow from the Fed, and borrowed resource may be 0 because they can borrow from the market in the first place. The discount rate is greater, but Fed fund rate is lower. So the Fed fund rate can be accessed by the banks in the market. So they will borrow from the market instead of discount window. Then the borrowed resources do not exist. Okay, so that's a normal circumstance in market operation. But if the banks, for certain reasons like limit problems and all, still when the Fed fund rate is below the discount rate, they might go and borrow from the Fed Reserve. That's a possibility, but that's a different scenario. But when the central banks supply the reserves, they decide how much to supply, the volume being defined by the central bank's operation. So it's a vertical function. They do not necessarily worry about the interest rates. They worry about the quantity. So they define the quantity and they supply. So it's a vertical supply curve. So as Fed Reserve's discount window exists, and also the Fed fund rate increases and it goes above the discount rate, banks will not borrow money from the Fed fund rate, because the Fed fund rate is now above the discount rate, and borrow more and more from the discount window from the central bank, because they have a profit opportunity. You can borrow from the central bank at discount rate and lend in the market at Fed fund rate that is above. But it is very rarely that happens, because the arbitrage opportunity provides and everybody else try to make use of this arbitrage, and automatically the market rates falls. Okay, at that point, the supply curve is horizontal. You can borrow any amount from the central bank at the discount rate. So supply curve become horizontal, usually vertical, but here it's become horizontal, and that's what you are seeing here. Let me first touch upon the supply curve here. The supply curve is the RS, reserve supply, right? So you see a quantity, the x-axis where you see non-borrowed reserves. That point is NBR, where you see a vertical supply curve. And then at ID, that is the discount rate of the Fed Reserve, you find the supply curve become horizontal. That's the supply side. So the market would borrow often in the vertical corridor, but when the market's opportunity persists for borrowing at ID, at times of IFF, the Fed fund rate is above the discount rate. So you probably find market is borrowing at a discount rate ID, and the curve become horizontal at that point, because you can borrow any amount as long as you have collateral. So that's the supply side. Then you see the demand side, RD, demand curve also become horizontal at the point of interest paid by the central bank for excess reserves. Okay, so you find a point where it's also parallel to the x-axis. That is the horizontal section of the demand curve, but generally it's downward sloping. As long as the Fed fund rate is below the discount window rate ID, the market operates in the downward sloping section until you find the horizontal shape section starts with the excess reserve compensation rate paid by the central bank. The intersection at point 1 decide where the market cleared Fed fund rate is. So it is no different to whatever the kind of demand and supply arrangements that you discussed when we were discussing about interest rates determination process at the very beginning of these classes that we started. So you see this market in terms of how the equilibrium being established. And continuing, okay, the changes in tools of monetary policy, how this affect the so-called market cleared Fed fund rate, right? So you see tools now: open market operation, discount lending, and then of course reserve requirement. These are conservative, okay, conventional monetary policy tools. So when you see effects of open market operations, there's a spelling mistake in this slide, and should be not be there. Okay, effects of open market operations depends on, okay, whether the supply curve initially intersect the demand curve in its downward slope section or the flat section. So if it is intersecting at the flat section, right, that is in the previous curve here in this component, right, changing the quantity would not have any impact to the interest rates. But if you see this market defined required volumes, or the supply intersects this demand curve in its downward sloping section, this section, okay, so you see interest rates changes with the amount of money the central bank supply in the form of this right supply curve that you are seeing. So this changes if the more volumes being supplied, then the interest rates decline. If less volume being supplied, interest rates increases, because this shifts towards a y-axis. So you see the market possibilities in terms of open market operations, and the effect of this open market operation depends on where the supply curve intersects the demand curve, whether it's in the downward slope section or it's a flat section. But if there is no compensation, this curve would be simply downward sloping, as we usually see in demand for funds in the market that we have discussed at the very beginning of our discussion. Okay, so you see, as I explained, an open market purchase, more open market purchase, right, that means more funds being released, okay, will result in Fed fund rate to fall, whereas open market sale, so less funds in the market, because when you sell, you absorb money available in the market, so the money supply reduces, right? So the Fed fund rate increases in such circumstances. But in both circumstances, our assumption is that it intersects the demand curve in its downward sloping section. Okay, so not intersection doesn't happen at the flat section, then even sale or purchase would not have any impact to the interest rates. So you can draw the curves and see when you see this type of arrangement, and we'll guess where the interest rates directions are, right? So similarly, open market operations have no effect on the Fed fund rate. As I already said, when the intersection occurs at the flat section of the demand curve. So when it intersects at the flat section, no impact. This is what we were seeing here. If this supply curve is here, anybody draw here the supply curve, any purchase by the Fed Reserve would be increase in the interest rates, but unfortunately increase in the money supply, but unfortunately not change to the interest rates. If it is selling, so the curve would shift towards the y-axis, but no change to the interest rates until it reaches the downward sloping demand curve section. Okay, so that's an interesting judgment from the curves that we looked at. And similarly, you look at this the different arrangements and the tools. If the intersection of supply and demand curves occurs on the vertical section of the supply curve, a change in the discount rate have no effect on the Fed fund rate. What you mean to say here is, we will come to this point, okay? But what you try to say here is, now we look at the demand curve. Now we are looking at the supply curve. You know supply curve is vertical and have a horizontal section, that is the discount rate section. So as soon as you see the intersection happens anywhere between this vertical component, vertical section of the supply curve, okay, any change to the discount rate that you are seeing would not have an impact on Fed fund rate. But it means here, if you look at this curve, right? So when you see this demand curve intersecting supply curve in its vertical section, so Fed fund rate is here at 0.1. Okay, but this is the discount rate. So if the market is here and changes to discount rate, unless it's substantially reduced, right, would not have any impact to the Fed fund rate. If you increase, no change, Fed fund rate is here, except the signaling, okay? If you decrease, it comes down, and it's still market determined intersection, equilibrium would not change. So that's what we are trying to say here, okay? So similarly, if the intersection of supply and demand occurs on the horizontal section of the supply curve, okay, change in the discount rate shift the portion of the supply curve, and the Fed fund rate may either rise or fall depending on the change in the discount rate. So here, that point, if this vertical section is here, let's say it is going like this. It is going like this. So if this is going like this, the intersection is here in this point. Okay. So when you see that intersection, what you see is the slides that I'm trying to kind of draw the line in the slides to show you. So intersection is here. Any change to the discount rate increase, market equilibrium also change, because demand curve is here now. If decrease, Fed fund rate also decreases, because now the discount rate is here. Increase, it increases, decrease, it decreases, because the intersection is here. Okay, so that's a different in terms of how the vertical section of the supply curve and the horizontal section of the supply curve intersects the demand curve, and accordingly the direction of market defined Fed fund rate that you are trying to kind of understand here. So it's no different if you look at the Sri Lanka's context also. The coal money rate is actually defined at the point where the overnight lending rate is there, right? So there's no change in terms of the open market operations increasing or decreasing its activities. So the change to the open market operations would not change the overnight deposit rate. That means the call money rate also sits on that. But if the supply curve is there and then there's a change to the overnight lending rate by the Central Bank of Sri Lanka, you probably see either it increases or decreases because intersection is in that horizontal segment. But usually if you see the normal market is vertical supply and downward sloping demand for reserves. So anything there would change with open market operations. So that's the clear message in terms of you have to see in terms of this tool being used by the central banks to accommodate, adjust, drive the interest rates in the economy. Okay. And then the reserve requirement. You see the third conventional tool is the reserve requirement. When the Fed, US Central Bank, increases the reserve requirement, the Fed fund rate also increases. And when the Fed decreases the reserve requirement, the Fed fund rate falls, because you naturally see when you other things constant, ceteris paribus. So if the other things change with this change, then of course Fed fund rate also would change. But assuming there's no impact, no other change, when you just raise the reserve requirement that you have to keep more reserves, then you demand more reserves from the market. So naturally, you see that the demand curve shift to the right. Okay, so when shift to the right, it's above the previous one, so interest rates increases. If Fed decides to cut the reserve requirement, then reserve demand is less, so the demand curve shifts to the left, and as a result the rates again decreases. So that's to some extent is explained here. You see what I was trying to explain in terms of the normal market condition. Here the supply curve is here, this vertical component, normal circumstances, and you see the demand component, downward sloping component here. So in such circumstances the equilibrium is here. But here if you lower the discount rate, there is no impact to the Fed fund rate, right? Only thing is the supply curve shifts down from its height, and you probably find market become tighter, in the sense rates are quite close to each other, right? But there is no impact in such an action to the Fed fund rate. But you see here, the intersection of the demand curve is not in the vertical, but in the horizontal supply component. So in such circumstances, when you do this discount rate lowering, you find the equilibrium interest rate, Fed fund rate, also decreases. Okay, so similarly, you see a point here. The original intersection is here, 1, okay, vertical, downward sloping. And then what you are seeing, increase in the reserve requirement. We were talking about reserve requirement. So you need more reserves. So naturally, the demand curve shift to the right. So new demand curve is this red line. So the new market equilibrium is 2. So the Fed fund rate is now higher. It's here compared to what it was. So that's how that responds for reserve demand and reserve supply circumstances. So another possibility here, again you see the intersection, original intersection is vertical supply, downward demand at point 1. But you see the reserve compensation arrangement by the Fed has been lifted from RD1 to RD2. There's no impact to the Fed fund rate, but what happened is the market become less opportunity cost-wise holding excess reserves, simply because now the compensation and the Fed fund rate are not that different. It's more or less close to each other. So another component here, the supply curve originally sits on the flat section of the demand curve. It's here. Demand curve is this, and the original supply curve sits on the flat section of the demand curve. It's here. So in such circumstances, if you increase the flat section, that is the compensation arrangement, it pushes up the Fed fund rate to 0.2 here. So the interest rates across the market increases in such circumstances. So these are all policy tools that the central banks very closely monitor and employ in terms of guiding interest rates in the market. And also similarly, right? So you see original demand curve, original supply curve, okay? Rightward shift to the demand curve, it's here, this one, are the rightward shift, right? Raises naturally the interest rates because more demand for reserves means demand curve shifts to the right, and rightward shift would increase the interest rates. And similarly, if you find a leftward shift of the demand curve, here this arrow should be to this side, not this side arrow. The head should be here. Okay, so leftward shift to the demand curve naturally pulls down the interest cost, and new interest rates would be lower. So that's what you are seeing here. Okay, so that's the kind of a conventional monetary policy tools that how this been operated in the market. So I'll get into precise definitions and details as we move on. Any questions? These are conventional monetary policy tools. So we'll get into the technical definitions and things, because that's also one area where sometimes the examiners are a little keen on looking at. Okay. So when you say conventional monetary policy tools, right? So when you say conventional monetary policy tools, okay, you can see here under normal times, the central banks, including Fed Reserve, uses three policy tools, monetary policy tools: open market operation, discount lending, and reserve requirement, through which they can control the money supply and the interest rates. Okay, so then you see here, what is this open market operation? Right? As a definition, it refers to the buying and selling of government securities in the open market in order to expand or contract. Buying means expanding, selling means contracting. Okay, in order to expand or contract the amount of money in the banking system. So ultimately, through the open market operation, the central banks influences the quantum of money that's available in the economy through the banking system. Why they kind of directly say banking system? Simply because everybody can't directly trade access with the open market operation. Who can access the open market operation is the banks, financial intermediaries. Purchasers inject money into the banking system and stimulate growth in a way. When you purchase, money is infused, and as a result, interest rates declines. So that's why they say stimulate growth, because cost of financing is lower. So the investments can boom in such circumstance. People can have less costly fund for their economic activity. So economy can boom in such circumstances. That's why stimulate growth. While sales of securities do the opposite. When you sell government securities from the open market operations, money available in the open market, right, returns to the central banks. So as a result, quantum of money available in the economy declines, reduces. So as a result, there's a push for the interest rates to increase. Cost of financing increases. People find that costly to borrow. There are kind of ripple effects to the economy, and then instead of stimulating the growth, it might contributes to reduce the growth. So these are the ways in which that you can look at these possibilities. Okay, so that is open market operation. Then you see a discount window refers to credit facilities, right, in which financial institutions go to borrow from the Fed Reserve. That's the established window, accessible often by the banks. Who access the window with the central bank is the banks. So the banks access the central bank's window and borrow funds, right? Right. At the same time, in some circumstances, they can deposit their excess funds, like in Sri Lanka. But in the case of US, when the banks have excess, they tend to kind of, do transactions in the market itself. So they normally some banks are access, some banks are short. Ultimately, they define where the overnight market interest rates are. In Sri Lanka, you have a deposit side, you have lending side. So the interaction will decide the interest rates between that deposit side and the lending side. Okay, so that's the Sri Lankan circumstances. But generally, the discount window refers to the credit facilities extended by the central bank in which financial institutions or financial intermediaries go to borrow funds from the central bank or monetary authority for that matter. These loans, which are priced at the discount rate, are often structured as secured loans to alleviate pressure in reserve markets. That means it's a collateralized borrowing. You can't borrow often from central banks without pledging your securities. Often government securities, you keep the government security and borrow from the central bank. Okay, so this discount window helped to reduce liquidity problems of the banks, because when banks require to kind of search for funds, they require either fire sell their assets. So that's fire selling of assets is costly because you will not get the right price. You are forced to sell, also costly, you will not get the right price. Okay, but you can go to the central bank's window and borrow funds at the defined interest rates of the central bank, right? So at the same time, you will not expose your financial difficulties to the rest of the market. If you borrow from the other counterparts in the market, market will know who is borrowing, who is short, who is having difficulties. But if you borrow from the central bank knows you are having difficulties. Central bank would look at them if you are repeating this liquidity facility or the access to credit window, right? So they will look at your books and they will closely supervise your financial requirements, and they will know, but they would not necessarily create a kind of, additional problem to the bank or the financial intermediary in the market, because market would not necessarily know who is borrowing from the central bank. Okay, so thereby the discount lending assists the banks to establish their financial stability and the stability of the financial market in general sense. Any questions? Then you see reserve requirements. Reserve requirements are requirements regarding the amount of funds, okay, that the banks must hold in reserves against deposits made by their customers. Right? Maybe a percentage, 2%, as I was telling in Sri Lanka now. Similarly, in other countries also, lower percentage that they announce from their deposits that they have to keep in the central bank. This money needs to be in the bank, central bank's vaults, And the central banks keep this as a recourse for banks to be operating within a kind of a stipulated direction. And by adjusting this reserve requirement, central bank also influence the money supply to great extent. And you know that through our discussions and the equations that we were discussing. So these are very broadly the defining of these conventional tools that we were discussing. When you say open market operation, it could be either dynamic or it could be a defensive. When you say dynamic open market operation, these are the strategies that the OMOs are implementing to increase or decrease the levels of funds available in the economy. The dynamic open market operations are the strategies that the OMOs employ to either increase or decrease the funds availability in the market. And this dynamism comes because this action to increase or decrease is initiated not in response to or in anticipation of other market events. Right? So for instance, central bank knows in advance the Christmas time. Central banks knows in advance the Sinhala and Hindu Tamil New Year period. Central bank in advance knows the Ramazan periods. So they know the money requirement in the economy increases during that period. They anticipate that period, the money supply to increase, currency in circulation to increase. So in anticipation of that, they sometimes do open market operations to release funds. So that is not what the dynamic open market operations are. Dynamic open market operations, not anticipating or in response to floods or in response to COVID. You don't do dynamic. So dynamic is the actions to increase or decrease initiated not in response to or anticipation of other possible market events. Dynamic is you are expecting a dynamic direction, that you expect the requirements in terms of economy growing at, let's say, of 2-3% possibilities, and because of this, money supply has to gradually increase. So you do dynamic open market operations, not because that you know in response to some event or anticipation of any events. So that is dynamic. Defensive open market operation. Here the strategy is used by open market operation in order to offset the anticipated market conditions that would probably affect the level of funds in the economy. Here you expected that, you become defensive by adjusting your open market operation. This is possibly very easy to explain. For instance, as what you see in the slide, if a foreign country is expected to sell its US Treasury holdings in exchange for US dollar, right? Every country in the world hold US Treasuries, USTs, in their reserves. a big central bank or a big financially strong country is planning to sell a big chunk of US treasuries and get the US dollars. And what happened there is, because the demand for US dollars in the market, sorry, the value of US dollar might increase. That means appreciate. So people are demanding more and more because big chunk of this US treasury being now about to be transacted in the international financial markets. So this would have repercussions to the US dollar exchange rate. Effectively to appreciate, because more demand for your currency means your currency getting stronger. So this have repercussions from other economic activities. So in anticipation of this, the Fed, US Central Bank, may decide to buy treasury securities in advance. Okay, you are selling. So instead of market buying, open market operation itself buy. They are buying means they are pumping out US dollars to the market. So thereby, the market balance is maintained. Okay, so even if you sell, that the selling would not have much of an impact to the market because of the Fed's anticipated action. The more liquidity in the form of US dollars being injected at that time, that moment of time. So that's a defensive. You expect a challenge to your economic variables and you respond in anticipation of that, and through which you nullify the possible effects to the variables that you are looking at. So that's a defensive. So you know dynamic, you know now defensive. Then in the open market operations, you know banks already, they're playing a very important role. Then you see primary dealers. Primary dealers are often the financial intermediaries who have access to primary offerings of government securities, like primary dealers in Sri Lanka. They are the ones they can buy treasury bills, treasury bonds from the central bank, and then they can sell it to their customers. Not all the banks are primary dealers, but in some countries, all the banks naturally become primary dealers. In other places, you may have requirements to become a primary dealer, and then you are going through a selection process. Then also in the open market operation, you have traps. Traps means not traps to kind of catch anybody, but these are trading room automated processing systems. So often open market operations not necessarily handled through manual processes. So you have systems, treasury management systems, and open market operation, the open market buying selling arrangements. Okay, open markets also conduct auctions to release funds or absorb funds. There are systems. So trade in room automated processing systems. So that's also important element of these open market operations. Then you see repurchase agreements, repo agreement, repurchase. You sell today with the agreement to purchase it back in an agreed future date. That is the repurchase. You have government securities with you, but you don't want to sell this permanently. But because I require a temporary funding line, I sell it now and agree that I will buy 2 weeks or 2 days down the line. Right? And you get the security. So that security is temporarily transferred from you to the other party, but you have agreed with him to do a repurchase. Open market operations do a lot of repos, and market do a lot of repos with the open market operations because they require liquidity. So they don't want to sell government securities permanently to the central bank. So they temporarily give it to the central bank and get the liquidity, and in return agree with the central bank to buy it back in the future. So central bank returns that at that moment of time. The market pays. There's an interest for that. That interest component also plays. The repurchase agreements also important in open market operation. So then you see match sale purchase agreements. It is something similar to first leg, second leg, same price swap arrangements. So you buy today at the same at a price, and reversal is also could be at the same price. If not, match sale purchase is not necessarily the price but volumes. You see government securities, face value this much, you buy and you sell. You match your sale and purchase. The market interest rates changes would define what's the payable amounts are. Okay, you just balance off. There are various type of match sale purchase arrangements. So you match one leg to the second leg. So you match the sale with purchase. Okay, so even an open market sell is matched with an open market purchase. So you sell today, that means liquidity being absorbed to the central bank when you sell. But you don't want it to make the liquidity change in the market, money supply change in the market because of what you have sold in the market. So what you do is you buy, correspondingly buy a similar amount to make it neutral. So you do a match sale purchase agreement in that sense. So that is also very important in open market operations that the central banks carry out. So what's the advantages of open market operations? This is very important, right? So when it comes to all these operations, the central bank have full control over open market operations. They are not depending on somebody else. Right? So the Fed has complete control over the volume of the open market operations. They can buy, they can sell. It's their discretion. Either defensive or either dynamic, they do that. And it's flexible and precise. So they can, as I said, they can buy, they can sell, they can do repos. It's flexible and precise in the sense what they wanted to do. You want to inject? Yes, you can inject. You want to absorb? You can absorb. And even if you have done something, you can easily reverse. Because you have sold, you match that with a purchase. So you have neutralized the market conditions. And much faster, you can quickly implement the open market operations. You don't want to kind of, depend on what the market is handling, what the market is doing. So very fast in terms of facilitation in the open market operation. Right? So then you see discount policy and the lender of last resort. So discount policy is the other policy tool, you know that. That is the discount window. And this could be lender of last resort facility. At times, if not, you have lender of last resort, partly with the discount window, but at an interest rate slightly higher than the discount window interest rates. When everybody else is not lending to you, the central bank is lending to you. That is lender of last resort. You don't have anybody else to, right, fall back. So you come and fall back on central bank to kind of, get the required finances. So you see discount window access. Generally, the entire market can have access to discount window when they wanted to have money with a collateralized arrangement. Then you see primary credit, that is also Lombard facility, like it's a primary credit. This is another type of lending the central banks extend. Standing lending facility. Sometimes this would not be available to all the market participants. Some selected group of financial agencies, for instance, licensed commercial banks. So even they could extend a credit arrangement through conducting auctions within open market operations below the discount window rate. When the market need excess, market is short and market requires funds, they conduct this type of arrangement. So there may be primary credit and secondary credit also there. It's also another lending facility. Same primary credit being extended for a secondary credit when you require additional finances linked to a same financial arrangement, or it might be independent of the first financing arrangement, the primary credit that you looked at. Then seasonal credit. Okay, as I said, festival season, right? The periods where you have other seasonal requirements. So you extend some additional facilities to some additional agencies. They are not normally allowed, or even the agencies who can access normal facilities under normal circumstances being provided with additional facilities in the form of seasonal credit at different times. Lender of last resort is again very important functions that the central banks perform, right? So this prevents financial panics, because you probably see when agencies have difficulties to access financial markets, so they become a part of market panic. So the central bank provide the facilities to alleviate market panic, but this create moral hazard problems. So you do not manage your agencies and you are not worried financial panics now, because central bank is there. Because central bank is there, you don't do your homework properly. You don't manage your treasuries properly. The banks could easily not follow the possible arrangements that they should be following, because they have a fallback in the form of central bank access. Central bank is lending to them. This is moral hazard. So that's the bad side of this lender of last resort facility. But yes, it's very important in at times of financial distress. So they probably having like one last resort. Not anybody else is lending in the market. Other banks would not lend to you, but you can go to central bank and borrow from the central bank. So what's the advantages and disadvantages? You looked at the advantages of OMO. Similarly, advantages and disadvantages of discount policy. Right. So it's used to perform role of lender of last resort. Discount policy works as a lender of last resort, particularly at times of financial stress. The central banks also extend the window and relax the requirements, right? Simply because the markets are excessively strained and it's difficult for the market at financial crisis circumstances. So the central banks facilitate. So it's an advantage of discount policy. So you see that could perform the role of lender of last resort. Anyway, central banks play the lender of last resort. But before you access the lender of last resort, even discount policy would be a lender of last resort, because market would not lend you, but you can come to the central bank and borrow. But unfortunately, disadvantage is the central bank cannot control the discount borrowing. borrowed reserves. It's a function of bank's decision. So when the central bank wanted to have discount policy be in access, they can't force the banks to access. It's the banks who decide to go to central bank and borrow or not. So the quantum flexibility all is not with the central bank. It's with the banks. Okay. Other thing is, as we were discussing in the curves that we studied a little while ago, discount facility is used as a backup facility to prevent the Fed fund rate from rising too far above the target, because you have a ceiling being established because of the discount policy interest rate. So otherwise, Fed fund rate could be simply going over the roof if there is no ceiling being established by discount facility interest rates. Thereby, it controls the market level. So that itself an advantage, the interest rates volatility being checked in this instance. Then the reserve requirements. Okay, there are various acts being introduced, but ultimately this reserve requirement is generally same reserve requirement across all financial intermediaries. At times it may be different, okay, but generally it's a single percentage that the central banks request banks to keep with them from their deposits. Disadvantage of reserve requirement is, as I was mentioning, once you start a 2% reserve requirement, that 2% cannot be changed every other day. It is reasonably binding for a longer period of time. So once you established and settle this 2% level, there is not much of a movement in reserve requirements. So it's no longer a binding to adjust macro variables or the interest rates in the market for that matter. But the biggest disadvantage is when you change this, you increase from 2% to 5%. All of a sudden, there's a liquidity problem in the market, because additional 3% may be huge. Then the market has to fund this. Cost of financing would increase. Central bank would have open market operations to adjust it, but still, the banks would have difficulties. They require securities to be provided for discount borrowing and things like that. But also, this increases uncertainty of banks, because banks doesn't know how much of their money will work for them. Okay, all of a sudden you change from 2% to 5%. So the bank's pricing structure for lending arrangements and their investment policies would also change, because now you require 95 rupees to work for 100 because of 5% reserve requirement, from 98 rupees for 100 previously for 2% reserve requirement. That's an example I said. So it increases uncertainty in the form of banks' operational decisions. Right. So you look at all these conventional monetary policy tools. Now you look at non-conventional monetary policy tools during the recent financial crisis, or for that matter, under other financial circumstances in the world. So the important message is the central banks uses both conventional and non-conventional monetary policy tools. But majority of non-conventional monetary policy tools being used at times of financial stress, financial difficulties. So what are these non-conventional policy tools? Often, at times of financial stress, financial difficulties, The central banks are required to provide for liquidity. So markets are drained of liquidity, and they want central banks to compensate or provide liquidity to the market. So they introduce liquidity provision arrangements. So liquidity provisions are non-conventional. It's not necessarily conventional. This is non-conventional. The Fed Reserve or other central bank throughout the financial crisis and now with the COVID circumstance, they have implemented unprecedented lending levels to provide liquidity to the financial markets all around the world. All the central banks in the world provide this facility. So they provide discount window expansion. Discount window is there, generally accessible for banks, but they do arrangements, liquidity provisions by expanding the discount window for other agencies also to access. Often, the discount liquidity provision arrangements come with a general overnight arrangements. Today, you provide liquidity. Tomorrow, you have to settle. If not tomorrow, again, you have to borrow. It's a continuous process by banks. But during crisis periods, they provide liquidity provisions by extending term auction facilities. It's for a term, duration, 1 week, 1 month, 6 months. Instead of 1 day, tomorrow reversal, you provide it for a longer duration, thereby reduce the uncertainty banks would have on frequently accessing the windows of the central bank. So the term auction facility is another very important. And then they have new lending program. During financial crisis, you know, troubled asset purchasing programs introduced. Mortgage-related institutions had troubled assets. They had assets, but the credit quality of those assets were very low. And they had assets that could not be converted to liquidity that quickly. So they had lending programs introduced by the central banks. It's not only in US, but also in other countries. Now in Sri Lanka, you probably see there are new lending programs during this COVID period, Saubhagya loan scheme. Okay, so the other one was the loan scheme introduced by the central bank to construction industry, tourism, and travel trade. The construction and other pharmaceutical agencies, they have provided services last year, but the government has not allocated money in the budget, and they had difficulties in passing a budget in the early part of this year. So the central bank provided collateralized lending facility, right? And with the agreement that the government would settle them in the future. Because anyway, government has to settle these industries because they have provided services to the government. So there were a number of new lending programs introduced during these periods in Sri Lanka too. Then you see very different and other asset purchase arrangements by the central banks all throughout the world, right? They had QE programs, QE, quantitative easing. 1, 2, now new asset purchasers. Even the assets of non-financial intermediaries, General Motors, the mortgage institutions, the biggest air passenger companies. So they did a lot of assets. They purchased a lot of assets. So these asset purchase programs also contributed in terms of new and non-conventional monetary policy tools in recent times to facilitate the market in terms of building confidence and to provide liquidity. And there's another element here that is not listed here. Another non-conventional monetary policy tool is forward guidance. Forward guidance. What do you mean by forward guidance? The forward guidance is that you are convincing the market with credible announcements. So you confirm the market that the central bank would not reverse, its current monetary policy stance for next 12 months time. So until next 12 months time, there would be no change in current monetary policy stance. In the sense, if you are accommodative, you will maintain accommodative stance for another 12 months at least. So market can constructively know central bank would not change the interest rates, change in the sense not increase the interest rates in the accommodative policy stance that they are now maintaining for the next 12 months. So market have a certainty where the interest rates for next 12 months. Or the central bank would say until, like US, until the US unemployment rates return to natural rates, they would not tighten the monetary policy. So when the US natural unemployment rate is something like, let's say, 4%, currently it is 8%, until it reaches 4%, they would not do anything to increase the interest rates, reduce the market liquidity, take out all these liquidity provision, asset purchases. So it's a convincingly they announce to the market their future course of action. So these were non-conventional monetary policy tools that you see in financial markets. Any questions? Right. When you see some specific elements in terms of ECB, European Central Bank, they also have open market operation. They don't target a Fed fund rate like, but they call it refinancing operations. And they anyway do term reverse transactions, not overnight auctions or overnight lending, but weekly. So they have refinancing operations. They do operations in the market to do refinancing. Market participants can access ECB and get the refinance arrangements done, but even for a reasonably longer 1 week duration. And also they have longer term financing. We were talking about term financing. Here they talk of longer term refinancing instead of weekly. It could be for 6 months, it could be for 1 year, a longer duration. Thereby reduced uncertainty among financial intermediaries. Then they have lending to banks. Right? So they have a lot of lending facilities. They lend on a marginal lending facility and marginal lending rates being announced. So marginal. This depends on their other financial transactions or derivative transactions. So they lend to these banks based on those transactions. And they had additional interest rates component, marginal lending rates also introduced. And they also had deposit facility. Banks could use deposit facilities as a part of lending arrangements by the ECB. So these were facilities they have extended, and also their reserve requirements, right? They had 2% of total amount of checking deposits, like checkable deposits that we were discussing, and other short-term deposits. They also expanded it to other short-term deposits in the case of ECB. And they remunerate. ECB is remunerating their reserve requirements, but it's very nominal. Very nominal. Very small kind of a compensation for reserves that they keep. And as we were talking all throughout, there are three players in this money supply process. As always, the central bank is there. As always, the bank is there, mostly the financial intermediaries, and third parties, depositors, you and me, and anybody else in the financial market. So with that note, we can complete this discussion. You have any questions? And also, with this lecture, I intend to kind of, finish because most of other programs also now finishes with the month of September, and let you all study from October. But you probably studied from the very first day of this program, so I don't see you required to separately sit down and revise now. So let you all prepare yourself for the exams, and I'm not sure whether the IBSL is planning to have a revision class arrangement. So if that's the case, there's one Janaka would do this part also. So you can facilitate, participate. That's fair enough if you wanted to. But you can go through the details of all the discussions that we had all throughout. And I believe for the first time I have not met any one of you. And I had all the classes online for this semester, and hope things would return very soon to normalcy. And you can prepare for your exams and prepare with your past papers. And I prefer to stop the discussion for this semester at this point. So all the very best for the exams and your preparation. And hopefully we'll be able to meet and one day exchange pleasantries. So I will stop at this point, and I will leave out for you all to put out any questions if you have. Thank you.